Hi everyone, today we're going to talk about TFSAs. Now, if you have a TFSA, you want to make sure that you're doing the right thing. Uh, Part of the conversation we'll be having today is mistakes, at least one particular mistake that I see individuals doing with their TFSA. Hopefully you're able to learn something from this. And if you're making that mistake, you can make the changes. And if you're doing great, well, this is confirmation that you should continue doing what you're doing. So let's talk about it. Before we talk about the mistake that I see a lot of people making with their TFSA, I'm going to lay some groundwork, some foundation, what a TFSA is, just so we're on the same page. So, what is a TFSA? As the name suggests, it's the tax free savings account. And essentially, it lets you save or invest money without paying taxes, right? So, and by the way, the conversation will be around saving and investing. We're going to talk about that. But let's, lay a little bit more foundation before we get there. You typically don't pay taxes on a TFSA for the money that you put in it, right? So the extra money you make from your investments, that goes tax free. The extra money you put in, if you're using it for savings, that interest also goes tax free. Now you can invest your money in different ways within your TFSA. You can use stocks, ETFs, mutual funds, seg funds, etc. There are a range of different things. But a big takeaway is any money you put in, the interest or the capital gain or the dividend that you may earn from that is completely tax free, which is one of the last opportunities we have here in Canada. So it's a great vehicle for investing, right? So let's talk more. Now, we talked about having a TFSA and using it for savings or investing. And quite frankly, the name tax free savings account is part of the challenge there because well, not say most, but a lot of people will look at the TFSA as a place for savings. So let's talk about savings and investing and just differentiate both. So the first thing is savings. Savings is putting money in a secure place and you earn a small amount of interest over time. And the whole point of a savings is usually something safe, secure, easily accessible. And this is usually for an emergency fund. You have 3 months of expenses, you want to have that saved up 3 to 6 months. In certain individuals, you may even want to go a year. And the thing here is you do not want to have that be subject to market volatility because you may need that money in the short term. So not only emergency funds, you may be saving for a car, you may be saving for a stove, a refrigerator, or maybe for something larger, maybe even a home. You're pretty close to getting your home, you're using the FHSA, you're using a home buyer's plan, and but TFSA is also part of that equation. So that's what a savings is. Essentially, put your money in a secure place, uh, for money that you may need to access in the short term, right? Now, let's talk about investment. When you talk about investing, you're putting money to buy assets. And the benefit here, the potential here is that you want, higher growth in value, right? You're putting money in with the hopes that you could get much, more decent rate of return than you would essentially get for savings. When you think of savings, you go to the bank or whatever the interest rates that's being offered. That's going to have an effect on how much rate of return you could get from having it in that savings account. Now, an investing is usually more long term, and you're looking for higher growth. With higher growth and opportunity for increasing value, what typically that comes with some degree of risk, right? And so the reason why you're thinking more long term is if you need the money in the short term and it's in something that's subject to market volatility, when you go to take the money, it could be a day or two before, you might have some fluctuations and negatively affect how much you have in that account. You may just lost money and now you're going and you're in a worse situation than you were in when you put money in, right? So you put money in and you've lost. So that's where in situations like that, we're thinking savings may make sense for the short term. Investing you is the best place, typically for long term growth, but then again comes with risk. So you may say, good, I could use TFSA for savings and investing. So where is the mistake? Well, talk about a mistake is the opportunity cost aspect of the TFSA, which means it's not unlimited. We hope it is. For many of us, we hope someday we get a bit more room. But for now, the cumulative amount is $95,000, right? And the annual contribution, as we speak, 2024, it's $7,000, right? So there's only certain amounts of money that can go into the TFSA. So if you have a couple hundred thousands of dollars and you're thinking about where to invest, if you have your savings in a TFSA, that means it takes away the opportunity to invest in a TFSA. Now, if you're saving in a TFSA, and we talk about savings again, it's, I'm talking about interest rate, which is usually lower. And I say usually because, in the recent times, we've, had some okay, decent returns. But in the long term, in most situations, what you're going to find is there's an opportunity to make a higher return investing. And if you have a bunch of money, a lot of your money in the TFSA where you are just using it for savings and getting a minimal rate of return, it means potentially you have money that is being invested outside of that TFSA that will be subject to taxes, right? So there's an opportunity cost there. And for many people, especially if you're looking towards retirement, using that TFSA for investing is super important and in the long run will make more financial sense. And definitely from a tax standpoint, it makes a lot of sense because as we said, there's tax-free growth. Now, this tax-free growth could be savings where you're earning minimal amount of interest, or it could be tax-free growth where you're making a decent amount from an investment growth from your investments, right? So that's one of the reasons why you want to potentially look to the TFSA as a place to invest versus save. The other thing is when you pull money from a TFSA in your retirement, it doesn't affect government benefits. A lot of government benefits are based on your income, and especially something like OAS. This is old age security. When you're pulling money from that, once you reach a particular threshold, you're going to have what's called potential clawbacks, right? So if you're making, say, $90,000 in retirement, this is over the threshold, then there's a potential clawback there. No, if you were taking, say, $30,000 from your TFSA, that would have brought you below that threshold. And so you wouldn't have that clawback, but you'd have received the same amount of money. So it protects you from, potential clawbacks or anything having to do with government benefits. And quite frankly, what it really does is it maximizes the opportunity for you to have a huge or a decent amount of retirement income because when you pull that money out, you're pulling it out tax free. Unlike an RSPs, unlike CPPs, unlike other pensions that you may receive. So what you're doing is creating a structure where, from a tax efficient standpoint, you have you know you have a portfolio that is more tax efficient, right? So they have a certain amount of money, but if it's not tax efficient, when you go to pull it out, you're going to be hit with taxes. So that's why I think TFSAs should be used mostly for investment for most people, for a lot of people, at least the clients that I see. It's more beneficial as an investment versus being used for savings. There's an opportunity cost there, right? So if you have hundreds of thousands of dollars because you're saving towards retirement, you definitely want to look to TFSA. You definitely want to look to maximizing your TFSA from an investment standpoint. Hopefully this was helpful. Hopefully you could take something away from this. And because you see tax-free savings account, don't think that the TFSA is only for savings. Or even if you know that you could use investment, really consider the opportunity cost here. We could be putting money into the TFSA and having tax-free growth in the long term versus having to pay taxes when you pull it from an RSP or even taxes from a non-registered account. Now, if you want to get a sense, because I'm just talking about TFSAs here, if you want to get a sense of decent sense of what your financial picture is, here's an opportunity. I have teamed up with a company where you could use this QR code to go there, get a sense of your financial snapshot, take a look at that. That may be helpful. And also, I have an Amazon bestseller, Art of Retirement. I've gotten pretty decent feedback, and I know I'm the author, so maybe think I'm just saying that, but I really have gotten pretty decent feedback on it. Say it's an easy read, and people have found this helpful. It's Art of Retirement, Canadian Guide to Retirement and Beyond. It covers retirement, and then it goes into estate planning. So definitely want to check that out. I'll drop links to both these things in the chat. That is all for today. And again, as I have conversations with individuals, I'll just jump on here once a week and I'll share that information with you. Have a wonderful week. Take care.